Hello and welcome to this 10th lesson in financial accounting. And what we're learning today is tangible non-current assets. So I'll begin with a brief overview. What are tangible non-current assets? So the perfect example, let's say we've got a business, a delivery business for that matter, and then we've got vehicles. Maybe you've got maybe a van, a Toyota Land Cruiser single cab. So that vehicle is what we can classify as a tangible current asset. Even a house, let's say um, we've got a house, right? We've got a house, then we're giving that house to the director of the company to use as his residence for the time that he's under employment with us. That also can be classified as a tangible non-current asset. So tangible simply means it has got physical form. You can be able to see it and touch it and feel it. So that's what we're looking at today. So let's begin. So the certain key definitions that you need to lay your hands on. So the key definitions is one, what is an asset? So an asset is an economic resource. So this is what you need to know. It's an economic resource which is controlled by an entity arising from past events, for which future economic benefit associated to the asset will flow to the entity. So we currently control the particular asset, but resulting from past events. So maybe we bought it 2 years ago, 3 years ago, or maybe 4 years ago. But we currently control it. So control is very, very important. So we control that particular resource resulting from past events. But at the same time, we're going to expect future economic benefit associated with that particular asset to flow to the entity. So in simpler terms, we're going to earn some money from employing that particular asset over the course of a period of time. So assets can be classified into two. There are non-current assets as well as current assets. So when we look at the statement of financial position, we're going to look at current assets as well as non-current assets. So the distinction between a current asset and non-current asset is a period over which that particular asset stays in the company, right? So this economic resource, which is controlled by the entity, if it stays in the business for just 12 months, that's called a current asset, all right? Then if it stays in the business for more than 12 months, then it's a non-current asset. So non-current asset simply means the asset is going to stay in the business and it's going to help the entity earn money for more than 12 months. Then if it's just 12 months, that asset or economic resource, which is controlled by the entity resulting from past events, is called a current asset. So now there are also two types of expenditures that you need to know. There's the revenue expenditure as well as the capital expenditure, right? So what is a capital expenditure? So a capital expenditure is an expenditure which results in the acquisition of non-current assets. All right, so remember, non-current assets, these are assets which are held by the entity for more than 12 months, right? So when we buy a non-current asset, for example, a vehicle, a motor vehicle, for example, a motor vehicle, the other example is a house, maybe an office building, the other example is a computer, the other example can be a plow, and many other items. So the money that we spend on buying that non-current asset is what's called a capital expenditure, right? So capital expenditure also involves spending money on improving the earning capacity of a non-current asset. So we've got a motor vehicle, right? And then we invest some money, not in fixing it, but improving the earning capacity, right? Maybe we change, say, the gearbox. So a vehicle, if the gearbox is not working, the vehicle is non-functional. So now, if the gearbox is damaged, then the vehicle is no longer working, and then we buy a new gearbox. So that man can be classified as a capital expenditure because it's improving the earning capacity. Without that particular expenditure, the vehicle won't move, right? So the other example is we buy an asset, all right, and then before we start using it, we spend some money. So all that money that's spent on making sure that that asset comes to its uh, normal working capacity, that's also classified as a capital expenditure. It is capitalized. So what does capitalized mean? So all capital expenditures that are capitalized, they are added to the cost of that particular asset. And that's what capitalize means. So capitalize simply means that amount is included as part of the cost and is reflected in the statement of financial position. So all capital expenditures, they are capitalized, they are included in the statement of financial position. And then when we have a capital expenditure, that capital expenditure is supposed to be written off on an annual basis. This is what we call depreciation. So an asset with say 1000 is supposed to be written off over its useful life. The useful life, that's the period over which that asset is used in the business. So it has to be written off so that maybe say in the next 5 years this amount of 1000 is supposed to equal to zero, and that means depreciating. It has to be consistent with the loss in value. Any asset that leaves the shop over time, it loses value, except for land. Land is the only item that doesn't depreciate. Then revenue expenditures. What is a revenue expenditure? So revenue expenditures, these are expenditures which arise from the day-to-day trading of the business. So items like rent, when you pay for rent, you pay for utility bills and all these other expenses which are consistent with the day-to-day trading of the business. That's what we call revenue expenditure. Right? Also, it involves maintaining the existing capacity of a non-current asset. So a non-current asset is running, it's operational, but for us to maintain it, not improving the earning capacity, but just to maintain its earning existing capacity, maintaining it. So for example, a motor vehicle, maybe you change the tires, all right? That's improving the earning capacity because maybe the tires are a bit worn out, then you change them, that's improving the earning capacity. Maybe the other example that we can give is for a house where you've got a house and then you just change the windows and maybe you paint the house. That's improving the earning capacity and that becomes a revenue expenditure. So here the most important thing that you need to know is this: capital expenditure and revenue expenditure. Capital expenditure, this is expenditure that is spent on purchasing a non-current asset and also improving the earning capacity of that non-current asset, and this expenditure is capitalized. Then a revenue expenditure, these are expenses or expenditure which is incurred on the day-to-day trading of the business, example utility bills and rent or other expenses. Then also revenue expenditures, they maintain the existing capacity of a non-current asset. And then these revenue expenditures, they're included in the statement of profit or loss. So these are the two facts that you need to have knowledge of. So now, let's look at the key distinctions between the revenue and capital expenditure. Right? So let's begin with capital expenditure. What is the purpose of capital expenditure? So the capital expenditure is used to acquire, upgrade, or maintain long-term assets. So upgrading and maintain here, it's in the context of improving the earning capacity. So for example, property, buildings, technology, and equipment, right? So capital expenditure is used to acquire, upgrade, and maintain. So here, upgrading and maintaining simply means improving the earning capacity. Then the duration, it provides benefit over a long period of time. So over a long period of time, which is largely more than 12 months, which is more than 1 year. So 1 year plus. Then revenue expenditure, right? Revenue expenditure. What's the purpose of a revenue expenditure? It's incurred for the day-to-day running of the business. So all those expenses that you incur when running the business on a daily basis, all right? Those are what we call revenue expenditures. For example, salaries, paying rent as I already outlined, maybe paying for insurance, and all these other items that are used to run the business on a day-to-day basis. Then duration, it's short-term in nature and it's fully consumed rather in the accounting period. So revenue expenditure is just 12 months or less, right? But capital expenditure is 12 months or more. So in an exam, you should be able to make a distinction between these two. And that way you can have some free marks. Okay, so now there's also what we call capital income as well as revenue income. Again, here you need to be able to make a distinction between capital income as well as revenue income. So what is capital income? So capital income, these are proceeds from the sale of non-current assets. So remember, capital expenditure relates to purchase of non-current assets. Then capital income relates to the sale of a non-current asset. So that's the capital income. So now, the only thing, or rather the only amount that's recognized in the income statement or statement of profit or loss is the profit or loss from the sale of a non-current asset. So let's say the net book value of an asset is 5,000, and then we sell it for 5,500. 5,500. So this excess 500 is what we call the profit on the disposal of a non-current asset. So this whole 5,500 is what we call the capital income, because this is the amount that's earned from selling this non-current asset. And this 500, that's the profit, and the profit is what we recognize as income in the statement of profit or loss. But if it was less, maybe it was the asset was sold for 4,500, and then that 500 is a loss. That loss is also recognized in the statement of profit or loss. Then now, what are revenue incomes? So revenue incomes are derived from the sale of trading assets. So an example of trading asset is inventory, right? So we talked of inventory in the previous lesson. So a trading asset is inventory, right? So when you sell inventory, that money that comes in from the sale of inventory is what we call a revenue income. Then the provision of services. So we provide services, maybe we're an insurance company. We provide the service to our customers. That money that comes in is what we call revenue income. Then interest or dividends on investment. So maybe we've got maybe 1 million in the bank account, and then we receive interest of say 100,000. That 100,000 is also called revenue, and it's included in the statement of profit or loss. Then dividends, we've invested in the company on the Lusaka Stock Exchange. The dividends that we receive from that particular investment is what we call also revenue income. So now, assets, as I already outlined, when you have an asset, you buy an asset, it has to be depreciated over its useful life. So how long we're having it in the business is a period over which we need to depreciate it. So now, in simple terms, depreciation is the amount written off from the value of the asset over its useful life. I've already explained this. So an asset has its useful life. That's the period over which we keep it in the business. That's the period over which we utilize it in the business. So that useful life, the asset is supposed to be depreciated over that particular period, and that's what we call depreciation. So writing off, the annual writing off of a certain amount of the value of the asset, right, is what we call depreciation. So now, useful life. Useful life is a period over which the depreciable asset is expected to be used by the entity, right? Right? Yes, that's the useful life. Okay, so now, useful life has already outlined. This is just a period. So if we're going to keep an asset for 5 years, that's the useful life. If we project to keep an asset for 4 years, that's the useful life. It's just a period over which we're going to keep the asset in the business for a certain period of time, right? Then depreciable amount is a historical cost. Historical cost, this is just the amount at which the asset was bought. That's a historical cost, or the amount substituted for the historical cost. It can be the net book value less the residue value. So the residue value, we're going to look at this. The residue value, this is the value of the asset after the useful life has elapsed, right? So if we've got an asset for 5,000, and then after its useful life ends, the asset is worth 1,000, This is what we call the residue value. This is the value at which we can be able to sell that particular asset. So now, here, residue value, as I've already explained, is a scrap value of an asset after it has lived its useful life. So basically, this is the amount at which we can be able to sell the asset after it has outlived its useful life. That's the residue value. So now, we've talked a lot about depreciation, and we also have to understand the methods of depreciating an asset. There are only two methods of depreciating an asset. We've got the straight line method, then we've got the reducing balance method. The straight line method is the easiest. So you just get the cost of the asset, you get the cost, then you less the residue value. The residue value, this is the value of the asset after the elapse of its useful life. The cost of the asset, this is how much you buy the asset, right? How much you buy the asset, including all these other elements of the cost of an asset, which we're going to look at, I think, in the last slide or so. Then over expected useful life. So an example, if the cost of an asset is say 5 and then the residue value is 2, then the expected useful life is say 3 years. So 5 minus 2 divided by 3, that's going to give us the depreciation that we're going to charge on an annual basis, right? That's going to give us the depreciation that we're going to charge over the annual basis. So here, given this example, our depreciation is 0.67, right? So now this 0.67, we need to be deducting it from this cost of the asset every year. Then we're going to arrive at the end, not book value or the current value, right? And then at the end of 3 years, what's going to result in this depreciation is this residue value of 2. Then the reducing balance method is a bit different. The depreciation is calculated by the percentage times the net book value, right? The net book value is the cost minus depreciation or the accumulated depreciation. The accumulated depreciation, for instance, we've got year 1, year 2, and then year 3. So in year 1, if we charge the depreciation of 1, then here we charge the depreciation of 2, then here we charge the depreciation of 3. Then we find the total. So 3 plus 2, that's 5, and 6 here. So this 6, that's the accumulated depreciation. That's the accumulated depreciation, right? So now, for us to find the reducing balancing method of finding depreciation, we need to charge depreciation. So let's say maybe the depreciation is 20%, right? And then the accumulated depreciation is 6, right? And then the cost, we bought the asset for maybe 10. So 10 minus 6 is going to give us 4, right? So the depreciation charge, the percentage of depreciation is going to be charged on this 4, right? And that's what we call the reducing balance method. So for the reducing balance method, the depreciation charge is multiplied by the net book value, and the net book value is calculated by deducting the depreciation or accumulated depreciation from the cost. So what's the accumulated depreciation? The accumulated depreciation is the depreciation over the period. So maybe we've got, say, 2 years of depreciation. So we've got year 1 and year 2. So the depreciation in year 1 and depreciation in year 2, if you add them, that's going to give us the accumulated depreciation. So now, sometimes an asset may be revalued upwards or downward due to one reason or the other. Maybe the market value of the asset has gone up, so we need to match that value. So now, the revaluation surplus. This is where an asset has been valued upwards. So it has been revalued upward above its net book value. So for instance, the net book value of an asset is 5,000, and then it has been revalued upwards by 100. So it's going to have 5,000 or 5,100, right? So this is the revalued amount, and then this 100, that's the revaluation surplus. So revaluation loss arises when an asset is revalued downwards. So for instance, we've got 5,000 here, and then we revalue an asset to 5,900, 4,900. So this is the new book value, but the revaluation loss here is 100. So now, how do we treat a revaluation loss and a revaluation surplus? So a revaluation surplus is recognized in the other comprehensive income. You're going to observe this when we start going through the statement of profit or loss for a company. So now we recognize it as other comprehensive income separately in the statement of profit or loss. Then what if we've got a revaluation loss? So when we've got a revaluation loss, this loss is supposed to first, you need to offset an existing revaluation gain. So if we have maybe a gain of 10, right, in the previous year, revaluation surplus, and then currently we have, say, a revaluation loss of 15. So we need to deduct this existing 10 revaluation surplus, and then what's remaining is what we recognize as an expense. Yeah, but for this level, I don't really think there's really much to think about in terms of how you treat the revaluation loss, but it's really important for you to understand how you treat the revaluation loss as well as the revaluation surplus. So sometimes you can have an asset, it has outlived its useful life, it still has a value. You can sell it off. You can decide saying, okay, I'm going to sell it off for a certain amount. So now, how do we calculate the profit or loss on disposal? So we need to get the net book value. Remember, the net book value, this is the value of an asset in the statement of financial position. That's the net book value. So the value that an asset is held in the statement of financial position is what we call the net book value. So you get the net book value and then you deduct the net sale price. So if the net book value of an asset is 1,000, all right, and then you sell it for, say, 1,000, 1,500, right? Then this is the sale price, and then this is the net book value. So the difference between these two is the profit or loss. So I think the better way, let me just try to revise this. The better way is this. The better way is you say this. So you say net sale price, right? Less net sale price less, so just a minute, net sale price so net sale price less net book value. Yeah, that's the proper way we can be able to calculate the profit or loss. Then if the net sale price is above the net book value, then we're going to have a profit. If it's less, then we're going to have a loss. Yes, so this is how we calculate the disposal on a non-current asset. So it's the net sale price minus the net book value. Then the excess is what we call the profit. Then the loss is what we call the amount, the shortfall is what we call the loss. So profit is recognized as an income in the statement of profit or loss, and then loss is expensed again in the statement of profit or loss or income statement. So now let's also look at what we call IAS 16, property, plant and equipment. So there's just a few definitions that you need to know. What is property, plant and equipment? So property, plant and equipment, these are tangible assets held by an entity for the production, supply of goods or services, rental to others, and for administrative purposes. So all tangible assets that are used in the production, maybe and they're used in the production. For instance, a machine that's used to produce biscuits, right? That's a property, plant, and equipment. Then assets which are used in the supply of goods or services, right? Maybe a delivery vehicle, for instance, that's also a non-current asset, which is a property, plant, and equipment. Then for rent to others, where somebody is renting on a lease, so this is found in leases. For this level, leases are not really as relevant. Then for administrative use, maybe a building that is used by the entity for as an office space, that's also a non-current asset. Then these are held and used for more than one accounting period. So putting everything together, these property, plant, and equipment, these are tangible assets held by an entity for production and or supply of goods or services, or rented to others, or for administrative purposes, and held and used for more than one accounting period. Then what is the cost? The cost, this is the amount of cash or cash equivalents paid or fair value of the other consideration given to acquire an asset at the time of acquisition or construction. So the amount of cash that we pay, that's the cost of the asset. Or the amount of cash equivalents. Maybe we pay in form of, say, shares. We pay in form of shares. Or maybe we pay in form of a debt instrument, right? Maybe we issue a debt. That can also be included as cash equivalents. Then the fair value of the other consideration given to acquire an asset. So this is where two assets are exchanged. So we've got asset A is exchanged for asset B. So now the fair value of asset B is what we recognize as the cost. Then residue value, I've already explained this. Residue value, this is the estimated amount of the entity could currently obtain for the disposal of an asset after deducting the estimated cost of disposal at the end of the asset's useful life. So I won't spend too much time because I've already explained this. Then the other thing that you need to know is fair value. What is a fair value? The fair value, this is the amount at which an asset could be exchanged between knowledgeable and willing parties in an arm's length transaction. So the value, so we've got asset A and asset B. So asset A is changed for asset B. So now the amount that we, the quarter amount that we exchange these assets, what we call the fair value. Then the current value, this is the amount at which an asset is recognized after deducting the accumulated depreciation, right? This is the amount an asset is recognized after deducting the accumulated depreciation and the accumulated impairment losses. So that's the current value. In simple terms, the current value is also called the net book value. This is the amount or the value at which an asset is recognized in the books. So this is the amount at which an asset is recognized after deducting the accumulated depreciation and impairment losses. Then recoverable amount. This is the amount the entity expects to recover from the future use of an asset. This is the amount of an entity expects to recover from the future use of an asset. Alright? And these are just a few things that you need to know. So now, how do we recognize an asset? So once we buy an asset, how do we recognize it as a tangible non-current asset? So number one, it must be probable that future economic benefit associated with the asset will flow to the entity. So there must be a high probability that if we buy a vehicle, it's going to result in an inflow, right? So we buy a vehicle for 5,000. For us to recognize this 5,000 as the cost of a non-current asset, it must be possible that this asset that we buy, let's say maybe this van that we buy, it must be able to earn some money for the company over the period in which that asset is kept in the business. Then the cost can be able to be measured reliably. So one, it must be probable that future economic benefits is going to flow to the entity, right? And then two, the cost of the asset must be able to be measured reliably. So you should be able to measure the cost. So if you can't measure the cost and there's no future economic benefit that is probably going to flow to the entity, then it won't be right to recognize that particular asset. So now, how do we calculate the cost? So there are these components of cost. So one, we've got the purchase price. How much do we pay for the asset? Then we deduct any trade discount. If we receive any discount, So how much do we pay for the asset? That's the purchase price, then less any trade discount. Then import and other relevant taxes. So if we pay any import taxes and other relevant taxes, those are supposed to be included as part of the cost. So we add it to the purchase price. Then directly attributed costs of bringing the asset to its normal working condition. So the typical example I give here is maybe you buy a computer. You buy a computer, right? But maybe it has got a system fault. It has to be worked on. Maybe you have to change the operating system of the computer. So now, when changing that operating system, it means the motivation is you need to bring it to a working condition so that it can be able to serve its purpose, which is in improving the earning, which is earning money for the business, right? That's if you're using the laptop for a business. So that expenditure on installing or installing the operating system, that's what we call directly attributed costs for bringing the asset to its normal working condition. Then initial cost of dismantling and restoring of the site where the asset is mounted. This is, for example, maybe an oil well. So an oil well, if they say after 100 years, we need to restore the environment where it was stationed to its normal state, then all those expenditures, the present value of that expenditure is supposed to be included as part of the cost, right? So you should be able to know the elements of the cost so that in an exam when you're asked to outline the elements of the cost, you can be able to outline. So we've got one, the purchase price less the trade discounts, the import taxes and other taxes, directly attributed costs of bringing the asset to its normal working condition, initial cost of dismantling and restoring of the site where the asset was stationed. With that said, our lesson has come to an end. Thank you very much.